Howdy, Jacob here. Today we're looking at Janus Henderson Group and Merry Christmas for those who celebrate. Hopefully you're having a good day and hopefully you're not actually watching this video today and you're spending time with people you love. But for the YouTube algorithm, got a post to make it most advantageous to me. I am not filming this on Christmas, by the way, filming it beforehand. But again, hopefully everyone has a great Christmas if they celebrate it in the holiday week of no work. And so we're looking at Janus Henderson Group, market cap 5 billion, 3.6 billion on the enterprise value, payout of about 5.21% on the dividend yield. Company itself 953 million in 2013 to 2.2 billion in 2022. Let's look at this net debt. There's a lot of cash on hand compared to debt here. So 300 million on the long-term debt, 1.2 with short-term investments. We're looking at about 1.7 billion in cash and cash equivalents and short-term investments, and only 300 million in long-term debt. And they make more than 300 million a year on a 5-year average basis. So it looks like they can, in less than a year of free cash flow, pay off all their long-term debt. That's comfortable. That's a comfortable investment because that can affect your business decision, but from a valuation standpoint, if there's so much of it or so little of it. But in this case, this is definitely going to be a safer bet, given the fact that they have such little debt and a lot of cash on hand, producing very solid free cash flow. So if we look at their dividend payout, let's see, 259 million and a 5-year average, let's see, 450 million, 880 million, 620, 30 million, 430 million. So let's say maybe 500 million free cash flow, and they're paying out 259, just above half, or it's roughly 50% payout ratio. What are they doing else with their cash? Making some investments, actually making some devastations pretty consistently. So instead of acquiring companies, they're selling off part of their companies, maybe, or I guess part of their portfolio, possibly. Maybe you're supposed to look at like the net acquisition and investment. Not entirely sure there. Buy back some shares, good amount of shares there. So it's going to be a company that is paying out a dividend pretty consistently. It looks like they can afford it. Let's get to setting some assumptions on the revenue and everything. I do want to note some things here. So in 2014 to 2015 and 2016, there was some pretty big changes on the margin side. So 43% gross margin up to 70%. And they've been pretty consistent in the low 70s. And then the operating margin side jumped from high teens to mid 20s, and it's been really mid 20s on average, maybe upper 20s on average. But some interesting things on 15 to 16, as you can see there, return on invested capital dropped a bit. Looks like that might have just been an earnings situation occurring. But yeah, so that's their selling off of businesses or possibly investments and such. But if we look at what they're going to do, I would say that this company is going to grow at 3%, and that would deserve a roughly 13p in price to free cash flow. I think that they've been making investments. They're an asset management holding entity. They have equity and fixed income portfolios. I think I'd be surprised if it didn't grow at 3% on the revenue side. And then as for margins, huge margins here, 20%, 25%. They have pretty much no debt, so I might just do pretty much what I saw there. And then on the share buyback side, let's be conservative, just say they buy back 2% of shares. With all this growth, I think we can be pretty fair to say that it would be affordable for them to afford a 3% increase on their dividend year over year. looks like they've been doing roughly that. Um, so then that gets us to a price pretty close to what it is right now. So expect me to do a deeper dive in a little bit, unless the company just keeps going up from here. If the stock falls a bit, I'll try to do a deeper dive on this. But for now, and in relation to the screener that we're looking at, it's definitely over 4% on the dividend yield side. I think they can easily afford it. I think that there's still growth left of the business, and with growth of the business, could increase your dividend, um, could increase the actual dividend itself, and could increase through both share buybacks and growth the appreciation of the stock as a whole. So for right now, um, just waiting a little bit more until it falls, and then I'll do a deeper dive on it and post that. But a few things I really like: free cash flows higher than earnings. I think that, although it has been flat, really actually down since 2018, I still think that there's some growth here based on what they do, and I think that it's a solid, pretty solid business. Pretty much no debt on hand, and net debt is way negative, way more cash on hand than debt. Gotta love that. So yeah, hopefully everyone has a Merry Christmas if you celebrate that, and otherwise are enjoying time off. Thank you.